Welcome, everyone, to today's Explainer. We're diving into Chapter 2 of our business and finance terminology. Now, learning new vocabulary really takes some focus, so we're going to keep things at a deliberately slow, steady pace today. For every single new concept, we'll repeat the English term 3 times so it really sticks in your brain, and then we'll follow that up with a simple English explanation to lock in the meaning. Let's get right into it. To help you organize all this information, here's our roadmap for today. 1. Assets and physical goods. 2. Corporate structures and control. 3. Investments and financial metrics. And finally, 4. Business risks and outcomes. Think of this structure as a mental framework to help you effortlessly store and recall all this new vocabulary. All right, Section 1, Assets and Physical Goods, Tangible Business Items. Take a deep breath, get ready, and let's practice our very first set of words. Listen carefully and repeat after me. Pharmaceuticals. Again, pharmaceuticals. One last time, pharmaceuticals. Basically, these are commercially manufactured medical drugs used for healthcare and treatment. Next up is jewelry. Let's repeat that. Jewelry. And once more, jewelry. You probably know this one. These are personal decorative ornaments like necklaces or rings, usually crafted from really valuable materials. Moving on, we have precious metals. Again, precious metals. One more time, precious metals. These are those rare, naturally occurring metallic elements that have super high economic value. Think gold, silver, or platinum. And finally, towels. Again, towels. One last time, towels. So this is a traditional unit of weight heavily used in parts of Asia, specifically for measuring those precious metals we just talked about. Now, let's look at how we actually measure the use of those physical items when manufacturing things. The term is consumption norms. Again, consumption norms. And once more, consumption norms. This represents the standard rate, or really the expected amount, of raw materials you need to produce a single finished product. Whenever a factory makes goods, they totally rely on these norms so they don't end up wasting materials. Moving right along to Section 2, Corporate Structures and Control, Business Organization.
Here, we've got 3 different types of corporate entities, and they each have a totally different level of ownership. First, subsidiaries. Again, subsidiaries. One last time, subsidiaries. These are companies that belong entirely, or at least mostly, to another company, which we call the parent company. That parent company holds the majority of the control. Next up, joint venture. Let's repeat that, joint venture. And once more, joint venture. This is a business arrangement where 2 or more independent parties agree to pool their resources for a specific enterprise. They share both the control and the profits. And lastly, associates. Again, associates. One more time, associates. These are companies where another investing company has a significant influence over their decisions, but they don't quite have full control over them.
Following up on those company types, let's look at the vocabulary we use to describe the actual power dynamics between them. First, degree of influence. Again, degree of influence. One more time, degree of influence. This refers to the specific level of power or impact one company has to affect the financial and operating policies of another entity. Next is control the issuer. Let's repeat that, control the issuer. And one last time, control the issuer. This just means having the dominant power to govern and direct the company that originally released a specific financial instrument, like a stock or a bond. Let's take a quick breather to review. Seeing these English terms for corporate structure lined up directly next to their translations is a fantastic way to visually reinforce what we just learned. Take a second to let that sink in before we move into our next section. All right, Section 3, Investments and Financial Metrics, Tools and Calculations. You're doing absolutely great so far. Let's keep up this steady pace as we dive into financial tools. Now that we know how companies are structured, let's look at their assets. First term here is fund certificates. Again, fund certificates. And one more time, fund certificates. These are the official documents proving that an investor actually owns a specific portion of a mutual fund or an investment fund. Next, held to maturity. Let's repeat that, held to maturity. And once more, held to maturity. This describes a type of financial investment that a company fully intends and has the actual ability to keep all the way until its final due date. Moving on, identifiable. Again, identifiable. One last time, identifiable. We use this to describe an asset that can be clearly distinguished, sold, or separated completely from the main business operations itself. And finally, fixed thereafter. Again, fixed thereafter. One more time, fixed thereafter. This is just a phrase meaning that a particular financial value or maybe an interest rate is set firmly in place and literally will not change after that specific point in time. Next, let's look at how we measure the changing value of those investments. First up, price gain. Again, price gain. One last time, price gain. This is simply the positive increase in the market value of an asset over a certain period of time. Now for the second term, weighted average. Let's repeat that, weighted average. And once more, weighted average. So this is a slightly more complex calculation. It's where each number in a data set is assigned a specific level of importance or weight, rather than just treating every single number equally. Now, I want you to take your time with this next one because it's honestly one of the most complex terms on our list today. Theoretical value of actual equity. Again, theoretical value of actual equity. One last time, theoretical value of actual equity. This is the carefully calculated on-paper worth of the true ownership stakes within a company. It completely factors in all of its realized assets and its liabilities. Basically, it's how accountants measure the true underlying value of a business. Okay, Section 4, Business Risks and Outcomes. Potential downsides. We've finally made it to our last thematic group. Now that we've covered investments, it's time to learn the vocabulary related to business uncertainties. Here are our final 3 terms, and these focus heavily on risk. First, probable. Again, probable. One more time, probable. In an accounting context, this means a future event is highly likely to happen. It's usually understood as having a greater than 50% chance of occurring. Next up, the loss to materialize. Let's repeat that, the loss to materialize. And once more, the loss to materialize. This refers to the exact moment when a potential financial reduction actually happens and becomes a recorded reality on the balance sheet. And lastly, risk of default. Again, risk of default. One last time, risk of default. This is the very real danger that a borrower will ultimately fail to make the required payments on a debt or a loan. Let's take one final visual pause here. Really lock these risk terms into your memory because they are incredibly common in literally any financial reporting context.
So the absolutely crucial point here is how all of these words interact in the real world. I want to leave you with this final thought to really test your new vocabulary. If a company faces a high risk of default, what probable loss might materialize for the banks that lent them money? Think about how those terms connect to describe a real, tangible financial scenario. You've done an absolutely excellent job focusing today. Keep reviewing, keep practicing that repetition, and I'll see you in the next explainer.